Are Robinhood traders ruining the market? And in today's video, we're going to be talking about, is the extreme ease of use of Robinhood and other stock market platforms and apps making investing feel more like gambling than ever before? Honestly, the ability to buy stocks has become as easy as downloading an app, linking your bank account, and voila, now you're an investor. In just a few clicks, you now have the power to put your money into any investment regardless of risk. The rise in the ability of people to invest their money is virtually anyone with a smartphone, tablet, a job, and a bank account, which at the current time I'm making this video is about 3.8 billion people out of the almost 8 billion people worldwide. Since almost anyone has the ability to start a brokerage account and put their life savings into that account, this can obviously cause some problems for individuals and also on the mass scale of the market itself. And I'm not even talking about Wall Street bets that is known for their absurd betting on companies with a make it or break it strategy. Pretty much make it big or lose it all mentality. This inexperienced buying of stocks has led many people and analysts to believe that markets will now become more emotional than ever. Since new and inexperienced investors seem to be more emotionally driven, the increased volatility will likely come from the mass panic both on the buy side and also on the sell side as well. A much higher increase on the fear of missing out mindset and buying things when things go up and frantic selling when things start to trend down a little bit. So with all that said, what should we be wary of? Well, companies that get overbought by these new investors will have bigger corrections when they do end up dipping down, and will also have bigger price swings when the price of an investment goes up as well. This can be pretty worrisome, especially when it comes to higher risk investment, because these type of stocks have an already increased level of risk from being seen as a more speculative play. So how should you and I invest in the coming months or even years to defend against this high volatility? Well, of course, it is hard to predict the future and to know exactly what will happen, but there are definitely a few things that I know will happen for sure. I came up with a list of a few things that will definitely help you out during these times. If you can remember the things that I'm about to tell you, you can definitely outbeat the market. First things first, profit taking will become a must during highly volatile times, and always be on the lookout for oversold stocks that you can reinvest those profits into. Second thing that you must pay attention to is your ability to stomach the big drops in the market and letting your winners run, meaning holding on while stocks are running up. The key thing to remember with this is only hold on to the winners as long as the fundamentals of the stock or the company hasn't changed. And since we're on the topic of fundamentals, remember that fundamentals like PE ratios, market cap size, overall valuations, and the revenues of a particular company will start to matter a little bit less. And the belief of the stock having future growth potential will start to matter more. This will have a greater impact, as we've seen with Tesla, Square, and other companies like this, than the current numbers that that company is currently pulling in. In short, valuations are going to be more based on the hope of a stock going up versus the actual quarterly profits or PE ratios or the overall fundamentals of the stock. And remember, not only are the climbs and the drops going to be bigger during these times, but the increased volatility will also speed up at the rate of which stocks climb. So stocks that maybe have been going sideways for a long time are gonna have higher highs faster and lower lows faster than ever before. And the next thing that I think will help you out greatly is by taking those profits that you make from certain particular investments that have shot up and reinvesting it with smart money, meaning big financial institutions. And where are they gonna be putting their money? Well, they're gonna be probably putting it into more risk-free investments. And obviously all investments have a degree of risk behind them. But what I mean is they'll probably be investing in companies that have been around for a long, long time, that have slowly increased their revenue over time as well, where the fundamentals are extremely, extremely strong. And in a lot of cases will also pay out some sort of dividend, so that way they don't have to continuously manage their fund that they're investing in. So even though value stocks and growth stocks are gonna do really, really well, as money goes in and out of those stocks and they go up and down, you're gonna see a massive push back into the fundamental stocks as time goes on as well. They will obviously have a more steady climb because money is going to slowly enter into those companies as the boom and bust happen in the overall stock market. So remember to take profits off the table when you have 50, 100, 200, or even 500% returns. Remember to take some profit off the table. It's never a bad thing to do, especially if you're able to put that wealth to work somewhere else where it can either A, make you more money, or you're protecting your wealth by putting it into the smart money stocks. So thank you all so much for watching one more time. And without further ado, I'll see you guys in the next episode. Peace out. Feel free to check out the links down in the description below where you can get a free stock from Robinhood, $20 free from Stash, 2 or more stocks free from Webull, or $10 free from M1 Finance.